In this series, we're going to discuss the IMF, the International Monetary Fund, and the World Bank. So the first thing you need to know is, what do these two institutions actually do, right? So the IMF and the World Bank were invented after the Second World War, and their purpose was to make sure that the world economy remained balanced and it never got so out of whack again that people would turn to extreme politics and the world would be destabilized. So the whole point is to make the world economy stable. And there's two different ways of doing this. So the World Bank is supposed to give loans at low interest rates to developing countries that otherwise wouldn't get them. And those are mainly used to make infrastructure. So for example, you could have a developing country like Ethiopia, and they might say, we really want to bring industry to Ethiopia, we want to have people set up factories here and produce goods for export, but we don't have enough money to create an electricity plant that would produce that much energy. And they go to private banks and they say, no, we're not giving you a loan, we know nothing about Ethiopia. And they can't do anything, right? They remain in this kind of perpetual poverty cycle. So the World Bank is supposed to correct that by giving them loans at preferential interest rates to allow countries to develop infrastructure and become richer and more productive and trading partners for everybody. Now, the IMF has a slightly different responsibility. Originally, it pegged salaries, so countries' it pegged currencies. So the IMF pegged currencies against each other, and this would prevent trade imbalances by forcing countries to devalue their currency if they were too far in debt, or forcing countries to increase the value of their currency if they were too far in credit, and things like that. And the other thing the IMF does is it gives loans for structural adjustment. So let's say a country was exporting wheat as one of its main exports, and however the wheat market collapsed because there'd been too much production of wheat over the past 6 or 7 years, and the price of wheat went through the floor. How is that economy going to adjust to that sudden change? And the IMF would give loans to countries so that they could adjust, so that the country didn't have to contract its economy right away, leading to more and more debt. It would allow that to kind of happen slowly, so the economic cycle wouldn't go up and down dramatically. It would go up and down in a more gentle way. And so we wouldn't have a situation where the world or countries' economies would be bouncing back and forth all the time in unforeseeable manner. They would be very stable. So that's mainly the purpose of these two organizations, to create stability in the world economy.